Hey, thanks. Thanks everybody for coming out. I'm trying to get used to being up on this stage, actually. It was easier this morning with a panel. But so today I'm gonna be talking about ICOs, crypto assets, and the IRS, and why we need triple entry accounting. But before I do that, if you could, next slide, please. Just tell you a bit about who I am, what my company is, and what we do. Essentially, what we do is we provide blockchain tax and accounting services. This is cryptocurrency tax and accounting for ICOs, for traders, for miners, basically anyone that's got transactions going on in the cryptocurrency space, and that's what we do. One of the things that we do, I call cryptocurrency forensic analysis, which is just sort of my way of describing the need to go through voluminous records from various exchanges, different wallets, different accounts, different crypto coins, different fiat, with the end goal of we need to know how much my client made, what was their income, and what was their closing position at the end of the year for these different crypto assets which they have. We prepare and file tax returns. We calculate any crypto gains or losses on those. And we also handle foreign tax issues because there's a lot of people in crypto who seem to have international issues, and we can assist you with that. Next slide. Next slide. So as an accountant, like my perspective on the space, and when we think about a blockchain, is that a distributed ledger, it's an accounting ledger. We've had ledgers since people were scratching marks on walls in caves. And today with a blockchain or distributed ledger, whatever your favorite term, a blockchain is a different type of a ledger, but nonetheless, it's an accounting ledger. Next slide. So to start with, we have double entry accounting. And this is the fundamental basis to track all of the transactions that we have today. In a double entry accounting system, the basis is called a T account. I've got one up there on the screen. You've got debits on the left. You've got credits on the right. And in its essence, that's all accounting really is. One on the left, one on the right, and these entries need to balance. Next slide. One of the other fundamental concepts of double entry accounting is what's known as the balance sheet. And that is a simple equation, which is that the assets must equal the liabilities plus the owner's equity. That's a balance sheet, and the company's balance sheet must balance. Next. So beyond the sort of nuts and bolts stuff of debit on one side and credit on the other, well, what is accounting really about? Okay. And the thing is, at its core, that accounting is about trust. And specifically, I think accounting is about the trust that we have to place in third parties to complete our transactions. Until Bitcoin came along, everything that we did, it's got to go through somewhere else. If I wanted to send value to Mike down here, I can't do it directly to him until we had Bitcoin. I needed to go through PayPal or a bank or a credit card or somewhere, okay? But it was all about trusted third parties, okay? So what else are we doing here? And I have a little trouble seeing my slides over there. With accounting records, what we have here is we're coming to agreement on a mutually accepted reality, okay? In this case, our reality is the financial information, the state of these transactions at a given moment in time, okay? In order for the system to work, we have to have the trust, okay? But it's third parties. It's a trust-based system. Without the trust, it all falls apart. So the investors, they trust that the auditor who prepares your financial statements is following all the rules. In fact, but again, it's all about your trust in the third party. Like me, I'm an accountant. Well, if you're out there and you have your own accountant, I hope you trust this person because we know everything about you. When we do your taxes, we know when you were, we know your date of birth, your children, all their names, how much money you made, how you made it, every single trade that you did. So it's important to trust your accountant. Okay? In blockchain terms, that coming to agreement on a mutual reality is sort of starting to remind me about validators in a blockchain, miners or whatever they are in your chain, all coming to consensus on the state of that blockchain. Next slide, please. Okay. Now, double entry accounting is great. We've been using the system for 500 years, but I'm going to stand up a bit. There's some problems with double entry accounting. And again, people are the weak link in the system, okay? Your computers will do, your code will do what it's supposed to do. People have a tendency to do things their own way. So because of people, and unfortunately they're flawed, we end up with fraud. If you don't have the adequate controls in place for your organization, some of the employees or the company, they can steal. And unfortunately, this stuff happens. It happens all the time, and sometimes it's on a big scale. It's just somebody pilfering a smaller amount of money. Sometimes it's on a gigantic scale. We are in Texas, so I couldn't hold back mentioning Enron, which, yeah, we remember that, right? Okay. The auditors are supposed to be your trusted third party. We're supposed to rely on what they're telling us, that these books are real, that this accepted reality is correct, except when we can't rely on them because they were corrupt, okay, in this case. So people are really a problem in this. One of the other problems with double entry accounting is this massive need for reconciling different ledgers. Now, Bitcoin is one ledger, okay? So the reconciliation is simply happens. But as accountants, me and all my colleagues spent gigantic amounts of time creating one ledger from different subsidiary ledgers, checking this, checking that, all different. And it's time consuming, it's expensive, and there's a lot of duplication of data here. So that's one of the issues. Next slide. So triple entry accounting is what we need and what we are now getting with the blockchain. It was invented by a financial cryptographer named Ian Grigg. And I'd just like to note that he wrote the paper on this in 2005, several years before we actually had Bitcoin. Next slide. So what is triple accounting, which is kind of the heart of what I want to talk about today, okay? Now, I was speaking just before saying, well, double entry accounting, this is all about trust, and particularly the need to have a trusted third party, your bank, your PayPal, what have you. Well, guess what? With Bitcoin, we don't need trust anymore, do we? Bitcoin is a trustless peer-to-peer system to transfer value from point A to point B. If I want to send my friend over here some Bitcoin, I do it. It's a push transaction from one address to the next. We don't need the trust, okay? That's part of Satoshi's genius. So in a triple entry accounting system such as Bitcoin, the third entry in this is the blockchain. We don't need a receipt in a double entry accounting system, and I just had a nice chat with Chris Odom all about this, who I just met. There's a series of receipts, whether they're paper or digital, okay, and they got to be signed by this party and that. But with the blockchain, we don't need that anymore, okay? And of course, the transactions are recorded in a cryptographically secure blockchain. The records, as we all know, are immutable. So therefore, if your records are immutable, you can't have any fraud. Does anyone here know how to reverse a Bitcoin transaction that's been completed? Anybody? Yeah, you can't do it, can you? It just doesn't work. Next slide, please. Okay. So Bitcoin, being the first blockchain, was and is a triple entry accounting system. By the same token, Ethereum is also a triple entry accounting system. We could talk a lot about the smart contract aspect and all that, but I'm focusing just on the value transfer, okay? So Ethereum is a financial token, and this is a triple entry accounting system. Again, we don't need a receipt, okay? That's the third entry is in the blockchain. In the same sense, an initial coin offering, a token sale is all part of Ethereum's triple entry accounting system. In fact, this is really the best app that there is for Ethereum, is creating new tokens and putting them on top, which is great. I'm not going to diss anyone about that. So, but one of the issues with an ICO is, and I don't know if anyone ever tried to actually look at Etherscan to see the transactions after the ICO happens. But this financial data, it's complex. It's really not very user-friendly. Believe me, I have looked at this, and it just takes a lot of work. So, strangely enough, although over $1 billion have been raised so far in ICOs, there's no easy way to extract the accounting information from an ICO. And there are people who are building some tools on this, and they're definitely making progress. But devs, build something, please. I have several ICO clients, and this is really a challenge. So go for it. Next slide, please. And I kind of just wanted to mention that there are projects who are building the tools for specifically how to handle the accounting information that comes out of an ICO. One of them is QuickBlocks, and this is a startup they're launching this weekend. No affiliation, it's just a friend. And they can extract the financial data and other data as well from the Ethereum blockchain. And I'm kind of excited about that one because I need these tools. That's part of the reason I'm giving this presentation. I want you guys to build tools because the only code that I know is the tax code. So I'm great. I'm great at using tools. I don't know how to build them. Another one is Balance 3, and that is a blockchain-based accounting system. They're one of the spokes of Consensus in Brooklyn. You may have heard of Consensus, largest blockchain dev shop in the world, right? You heard of Consensus. So that's another one. Interesting to note, although I've kind of been speaking about triple entry, using a financial token like Bitcoin or Ethereum, you don't actually need a financial token like Bitcoin or Ethereum to have a triple entry accounting system. Chain, which is another blockchain startup, they've just launched a project called Sequence, and it is a cloud-based ledger service for managing balances in financial and commerce applications. Chain doesn't have a financial token. It's a distributed ledger. It's a blockchain database. There is no chain token out on Polo or Bittrex or what have you. Next, please. So kind of having thrown you right in from double entry accounting to triple entry accounting, I'm going to go towards something which I'm actually a lot more familiar with and where I spend most of my day, which is cryptocurrency taxation. And, there were some other people earlier this weekend discussing crypto taxation. So I'm just going to kind of run through some of the basics here. Per the IRS, Bitcoin and virtual currency, it's a type of property. And when you buy or sell Bitcoin, it's treated the same way as if you buy or sell a stock. You have a cost basis. You sell when you sell or exchange it, you're going to have a gain or loss, which is the difference. And considering that this year, I think we started at about 1,000, and today, who knows the price of Bitcoin today? Somebody's got to have this. It hit 6,000? Nice. I get paid in Bitcoin, okay? So, yeah, good stuff. Yeah. What do you think I'm doing in this space anyway? Why did I learn about, crypto accounting? I mean, I had coins. So, but I did want to note that cashing out into dollars is not the only event that's going to trigger tax. It's kind of a common misperception that the tax is triggered when you convert the Bitcoin to dollars, fiat, but also you exchange them for goods, for services, or other property, including another cryptocurrency, which leads into the next topic, and it looks like you're interested in this one. Wait till you hear this. I don't have good news for you. Next slide, please. A Section 1031 like-kind exchange is a part of the U.S. tax code that was created for real estate transactions. And under certain very defined under certain circumstances, you can take property A, and then you can exchange property A for property B, and you defer the tax on this transaction. Okay, and it was created for real estate transactions, and it's still the primary use of a Section 1031. Well, a lot of people have asked me this question: can I do a like-kind exchange for Bitcoin or any other coin? I've actually probably been asked this question an average of at least twice a week for the last 2 years. So, I mean, hey, who wants to pay taxes anyway? I sure don't. If I knew a magic way to make all this go away, I would, but nothing. Crickets. So, in order to have a valid like-kind exchange, the property being exchanged needs to have the same nature or character. Okay? So, the kind of property has to be the same type. I can't take a house and do a 1031 exchange for a boat. It's real property versus personal property. And what I'm trying to say here, and I've been saying this to a lot of people for a long time, is sorry, folks, but like-kind exchange for virtual currency fails completely, utterly, doesn't work. I don't sign those tax returns. I never have. Unless something dramatic happens and the IRS specifically says, yeah, you can do this, okay, but until then. I also found some IRS revenue rulings to back this up. There was a revenue ruling saying you take $20 gold numismatic coins, and they were exchanged for South African Krugerrands, okay? And this went to the IRS, and they said, no, you can't do that, okay? There's another one that exchanged gold bullion for silver bullion, okay? Kind of like Bitcoin and Litecoin maybe, right? And that didn't work either. The IRS said that's not like-kind. Next slide, please. The final one that I found under this topic is for the exchange of Swiss francs for U.S. gold coins. And again, the IRS ruled that, not the IRS, it was a court case. Swiss francs were a circulating currency issued by a sovereign government, because that's what governments do, except that today we live in a world of Austrian economics, but we'll get to that. The character is different from gold coins. Their value, for their numismatic value. And the currency can't have the same nature or character as metal coins. Now, why am I laying all this stuff out? Because blockchains are not interoperable. I can't take Zcash and send it to a Monero wallet. I can't take Ethereum and send it to a Bitcoin wallet. It doesn't work. And that's because each of these blockchains have a different nature or character, and they are different and distinct types of properties. And unfortunately, that's why I think a like-kind exchange won't work for crypto. If there's anyone, I got 5 minutes. I better speed it up. Okay. So that's that. Next slide, please. Okay. So moving on to that, which is sort of a downer topic, taxation of ICOs. Now, I kind of led into that because these exchanges of different coins are exactly what happens during an ICO. I own 1 Ether, and that's got a cost basis of $100. Today, Ether is $300. I send it to the smart contract, and I exchange my 1 ETH for 10 Daniel coin, okay? I've taken Ether, one type of property, I've exchanged it for another type of property, different virtual currency. Next slide, please. Okay. Now, what do we have here? Well, essentially, you treat this as if you have to convert the values to dollars, and when you convert your Ether with a $100 cost basis and receive other property, you have $300 of proceeds, you have a $100 basis, and you have a $200 capital gain, which you need to report on your taxes. Okay? As far as the Daniel coin, that's simpler. You have 10 Daniel coins, you paid a total of $300 for them, you have a cost basis of $30 each. The reality, of course, is much messier and much more complicated, but those are nonetheless the basics of what happens during an ICO on a much larger scale. Next slide, please. So just to sum up here, as I was going to this presentation and looking at ICOs and all the massive time that I've spent going through sometimes $5,000 or $10,000, or 5,000 or 10,000 trades per year for some of the heftier clients, and it got me thinking that basically our big problem here in crypto is the volatility, which makes it very difficult to use Bitcoin or any token as a unit of account, because we love it when the price goes up, but it kind of makes it hard to have a Bitcoin denominated life, okay? So, well, how do we fix volatility? Because we have an unstable crypto, right? Well, there are a couple of solutions that I came across, and we'll see what happens. One of them is a project called MakerDAO, which, disclosure, I own about 2 Maker. It's worth maybe $400, and I've done a little work for some of the U.S. team. Maker is a stable coin which is backed by Ethereum. So that's what they're working to do to eliminate the volatility so that we can all keep doing our peer-to-peer transactions without having to deal with third parties and, God forbid, a bank, okay? The other spectrum here are central bank issued cryptocurrencies. There are banks not in the US, but Western Europe, South Africa, actually, the best paper I've seen on this is out of South Africa. So I am positive that at some point, I don't know if it's 5 or 10 years away, sovereign governments are going to tokenize their fiat, okay? And that's what we're going to get. Now, the problem with that is that now every single thing we do has become completely trackable, and we don't want that. We want privacy, okay? So the last thing I'll say is this kind of represents 2 ends of a spectrum. So here's my open question. Well, we have an issue. It's volatility, and there are people trying to figure out how to solve this issue. What do you guys think? Who's better at finding an efficient, marketable, workable solution to a problem? A blockchain startup or the government? Thanks a lot. Yeah, sure. Please.
Okay, we're going to have about 15 minutes for questions, so please raise your hand and I'll come around to you with the microphone.
Thank you. And I'm not going to put you in an uncomfortable spot. So let me say
That's okay. I'm only standing in front of a room full of people. It's cool.
All right. Hypothetically, not anybody in this entire room or even this conference I know would ever try and skirt taxes. So that's not what I'm asking. But I've heard it said that theoretically, if you had all your money in, let's say, Bitcoin, and it grew to billions of dollars, and you want to live a nicer lifestyle, that you can get just about anything bought somehow or other through crypto, and nobody's going to find out. Because the nature of it is that you could just, the far extreme is you meet a guy on a scooter and you have, he gives you some money and you give him some crypto, and there's no way for the records to ever show this.
Provided no one ever identifies your wallet. Have you heard of Chainalysis? They're a blockchain analysis firm. Their customers are law enforcement and the IRS.
Oh, lovely. Okay.
Yeah, that's who they work for. The IRS understands the blockchain. They don't have it. I'm not... But go ahead.
All right. Well, this is really my question. My thought of the whole thing is let's make lots of money, and if we pay taxes, we pay taxes. But the idea that we're going to live under a rock and still be successful, you just don't see it happening, right?
Well, I can't advise it.
Right.
Clearly.
I understand. Okay.
Usually the issue that happens when people come to me is that they've either realized or about to realize some significant gains. And, it's a little inconvenient when you get significant money in a bank account without being able to document the source of all this. So, anyone?
Yeah. So, for us that would never ever skirt taxes and never, or be anti-tax, but for someone who, in the similar situation to maybe some of us in the room, the benefits and what kind of deductions are allocated for people to get into this space, because there's always that two-edged sword, right? Or the two-edged sword. If I'm going to be super crucified by taxes, what kind of deductions are there in the crypto space? Can I deduct cost of miners? Can I deduct the crazy losses in an ICO? Are those the kind of deductions that that we can also benefit from as entrepreneurs that make money other places, but then going to get in the space and lose our shirt, but heck, get the deduction?
Absolutely, yeah. And I've dealt with every single one of the things you just talked about because some of my clients are minors, okay? And the IRS has actually stated really clearly that to determine the income from mining, you essentially take the revenue stream is the U.S. dollar value of the coins received per day. Some coins don't necessarily have an easy USD value, but if we can get the value in Bitcoin, we just convert it back to USD. So mining revenues are equal to the USD value of of coins received on any given day. Expenses, same thing. There's a lot of miners that they're kind of are Bitcoin denominated, right? It's kind of hard to pay your electrical bill, okay? But when you pay a subcontractor and you send them $1,000 worth of Bitcoin, your expense is the USD value of the Bitcoin on that given day. As far as losses and ICOs or other things of this nature, we don't always all come out on the right side, on the better side of a trade. So since every single one of these virtual currencies are capital assets, if you sell or otherwise convert a given coin for less than you paid, you have a capital loss, and I'll put that on your tax return. This also applies for stuff like when Bitfinex was hacked. But that doesn't directly answer your question. But yeah, there's definitely deductions are available. Go ahead.
Quick, tiny follow-up.
Yeah, sure.
What about the case of like these ICOs that maybe they raise a bunch of money, but they run off the funds, never technically? I mean, when are you allowed to say, well, I'm just call it a loss? But technically, in theory, in 10 years they can maybe figure it out and then come back to their conscience. You know what I'm saying?
I do, and that's a little trickier because I always go back to the fiat world, which of course is where we all started. So, in the case of a stock, say, okay, companies go bankrupt or something goes wrong, okay, badly wrong, and what was previously a publicly traded stock gets delisted from an exchange, okay, and the value of this can go to nothing, okay. In that case, you would now have a worthless stock or security, and when I file your taxes, we write off the original cost basis for this investment and consider it a sale on the last day of the year. I've done the exact same thing for people who were crypto investors, and we just analogized this to, I more or less said, well, what about this and what about this? Yeah, their project never really got off the ground. It got delisted off the exchange. Value's nothing. I said, okay, fine. Let's figure out what you paid for this in the first place, and then we'll write it off.
So kind of like a follow-up to that, what if...
When it comes back, it becomes like one of those debts that you wrote off, but then realized later on after.
Yeah, I know what you're saying. So far, I haven't seen that happen, but the analogy is... I'm sorry. I mean, look, if you're in a crap coin, it's underwater and got delisted, it's probably not coming back. But yeah, you got to have hope. Sometimes what happens if in a normal fiat world, if you take a loss on something and it turns out that later, actually, no, the loss wasn't that large, you end up realizing income, you're basically going to have to go back and amend that original return or pick it up in the current year. And that's a little technical. I'd have to check that, but that's the big picture.
All right, guys, let's stick to the microphone, please, so we have order and we can get all questions asked properly. Thank you.
Kind of like a follow-up to that question, not related to ICO, but let's say your account got hacked, like your cold storage, someone took it, and then you claim it as it's a loss. But how would you prove that it was lost?
Okay, I've seen the situation, unfortunately. Well, the biggest example I can think of was the Bitfinex hack last year, was something like $60 million worth of Bitcoin, I think, was stolen off of that exchange. So there's two ways to treat what was a theft loss, okay, or a casualty loss. I mean, this is things like there was a flood, your house was destroyed, and you ended up with an out-of-pocket loss that wasn't covered by insurance. But so let's go to crypto. So the two ways to treat this are either a theft loss, which is not going to get, you probably won't be able to take the theft loss or casualty loss. The reason why is that okay, I don't have a slide on this one. Before you can deduct a casualty loss, it first has to be larger than 10% of your income. Okay? So if you have $100,000 income and your loss is and your theft loss is $11,000, first you take off 10% of the 100, which is 10, and now you only have a $1,000 loss. And that's the result when you would treat this as a theft or casualty loss. Luckily, people who owned crypto on Bitfinex they're basically investors, right? So there's a pretty solid argument, and I've done this, that it's an investment loss, which just means you take your original cost basis, sale for zero, and that's your loss, and we put that on your taxes. So, and your question was more about the documentation for this, and my answer is clients provide me facts. They have the proof of this, and in the unlikely event of an audit, they will need to provide that proof. So in this case, okay, and I hope this didn't happen to you, you had a coin in a wallet, and somehow someone hacked in there and moved it, okay? Well, you had the private key to this, or the password, or whoever, depending on how it was held, so that was yours. You had possession of this. Well, in this case, all you got to do, I think, is go back to the blockchain and do a screenshot of this and just show that, yeah, that coin's gone, it left, and I didn't make that transaction happen, so they stole it. There's an idea. I like that. Thank you.
Okay, next question.
Has the IRS provided guidance on the valuing of purchases with cryptocurrencies?
Can you give me an example?
Yeah, so you buy a car and you do your dollar cost basis. Do they value it based on the value of the item you're purchasing or the dollar value of the Bitcoin?
Wouldn't it be the same?
Maybe not.
How could it not be the same? If you're buying a car and you have to give them $10,000 of Bitcoin, I don't see how you can have two prices, because you just gave them $10,000 of value for one car. So maybe I'm a little confused, but how do you get to two prices or two values on that? Sorry? You say timestamp? Well, I'm not sure that was quite the question, but...
Here's a question I think that may bring it to light. So if I sell Bitcoin, what price am I using? The place from which I sold it on an exchange? You know.
You're right, it's not in dollars, but the IRS only speaks dollars. So everything that I'm doing, whether it's for miners or traders or someone like you who just buys a car for Bitcoin, we have to get the price back to dollars so that we can actually get it, because of that volatility problem that I'm talking about, and the IRS only speaks dollars. So if you sent someone a USD value of $10,000 for a car, you have exchanged your Bitcoin for an item worth $10,000, and then you will have a gain or loss to you personally, depending on which is a swing between the $10,000 fair market value and whatever you paid for those coins to begin with. As far as you were asking about what rate do we use, like I think Jen with the microphone, was that it? Yep. Yeah. So the answer is the IRS hasn't said anything in particular about that one. Early on, when I first got into space, I got a little hung up on rates, but it's really not a big deal. CoinDesk has historical price index. So really, we just need to use the average rate in effect on the day. Sure, we have volatility. And when necessary, we can use a spot rate when it's a material issue, yes. But basically, we can just use the average rate for the day. CoinDesk has a data dump. You can get that stuff. There's other sources. And, Poloniex and Bitrex, they've got APIs, and they track the prices of hundreds of different coins. If you know what the value of a given coin was on a day in Bitcoin, we can get it back to USD and value it.
Aside from the gaining control aspect of it, has the IRS come out with any guidance on the inheritance or estate tax portion of this being an asset to an individual?
The only thing that the IRS said directly about Bitcoin was a 5-page notice issued in March 2014, which explained how they treated particular transactions, among them mining. They didn't say anything about inheritance tax. They did say that Bitcoin's property, as I said. And in the notice, they said, anything not directly addressed here, please see the U.S. tax code. So the big picture answer to your question is if someone that people own all kinds of different property, right? Homes and cars and boats and crypto, and that seems perfectly sensible to me that the virtual currency property that someone owns would be a part of their estate. And by the way, if you know anyone in that spot, folks, make sure that somebody else, in the event of you getting hit by that proverbial truck, can access your crypto, because that would stink if you died and your value went poof.
It'd be better for everybody else, though. The value goes up. Another question.
Wait, but nobody knows about it. Remember, it's lost.
That's right.
It's one of those. Go ahead.
Supply and demand, right? So, what about for the people, not myself, that are pretty pro risk when it comes to the tax part of Bitcoin? Is there a statute of limitations where if you can just, in this like young area of Bitcoin like adoption, if we can avoid the big bad boogeyman for X amount of time, is there a clock with the tax code right now that one day we can put our nice fingers up towards the IRS and be like, cool, we're done?
And you want to know the statute? You're asking about the statute of limitations?
Yes.
For the IRS? Yeah, it's 3 years. When the return was filed.
Gotcha.
If the return was never filed, the statute's open forever.
So do you just have to make sure that you would at least do some kind of return that was filed?
Well, I don't do some kind of return.
Right.
and neither are any of my clients.
Right.
I book everything.
Gotcha.
And once in a while, it's like, oh, well, there have been many times I've said to someone, oh, well, what about this thing? Do we really need to do something about this? Yes, we do. Yeah, I mean, I might be in an edgy industry, but, I'm kind of by the book. I'm so conservative that I'm a crypto accountant at the Texas Bitcoin Conference, yes. I'm screaming conservative. No risk interest at all. Anyone else?
Do you have much knowledge on trusts?
Actually, that's not an area where I have a great deal of knowledge, but I know a really killer tax attorney up in New Jersey.
So is it potential in general that one could put Bitcoin in a trust and only be taxed for the price of the Bitcoin that was in there in the beginning?
Frankly, that question is about my pay grade. I'm not really knowledgeable about trusts.
Okay, I think it's the founder.
All right, we got time for probably one more question. I'll go with you.
Hey.
As a new investor, I haven't pulled anything out, converted anything back into fiat. Everything's still just out there in various tokens and Ether and so forth.
And remember, selling to dollars isn't the only way you're going to realize income.
So that's my question is this next tax cycle, in the spring, what am I reporting on? And is there like a spreadsheet that I should be filling out to track all this? Like what's the best way to track and am I reporting on this next cycle?
It kind of depends. Well, first of all, the best tool that I've seen for handling crypto gains is bitcoin.tax. I have ran upwards of 10,000 transactions through that website. It's really good. Okay? I have no interest there, except it's a really good tool I use continually. So to answer your question, if all someone is doing is buying crypto, well, there's nothing to report if you're just taking USD and buying Bitcoin or what have you. But if you then take Bitcoin and then sell it and buy Ethereum, now you have to report something. And I don't know the rest of your fact pattern, but the key thing to making this easier is records and tracking stuff. It's a lot easier to deal with records coming off an exchange like Coinbase or Polar or Bitrex. But once you start messing around with Ether Delta and private sales of ETH coming out of a wallet, it gets a little trickier, and then I do forensic crypto accounting on that. But it can be done, just takes more work.
Okay, guys, we're going to wrap. I know we get a lot of questions. One last thing. Daniel can't service everybody. So any recommendations on where people can go to find qualified help?
Well, in Texas at the moment, it's me and Jason Tyra.
Well, very good. Everyone, Daniel
That's
Winters.
two I know of.
Thank you very much.